What if I told you the men and women tasked with safeguarding our global economy, the central bankers, are currently making the very same catastrophic, mathematically unsound decision that spiraled the world into its deepest ever depression? It's not just an echo of history. It's a terrifying replay. We are not talking about a minor recession. We are talking about the ghosts of 1931, a year that saw the global financial system collapse, not from a singular shock, but from the hubris of its custodians. They told us they learned the lessons. They told us their tools were elite. Because right now, the most powerful institutions on Earth are tightening the ropes around the neck of the global economy, repeating 1931's biggest mistake, and preparing for the inevitable fallout they themselves enjoy. To understand the gravity of the present, we must first look back at the abyss of 1931. The world was already reeling from the speculative euphoria of the late 1920s and the crash of 1929. But the true systemic failure the moment the crisis metastasized occurred. Not in a stock exchange, but in the corridors of the world's central banks. The gold standard, a rigid, unforgiving system, demanded discipline. But following the initial shock, what the global economy desperately needed was liquidity, flexibility, and a steady hand. Instead, key central banks, particularly the Federal Reserve and the Bank of England, committed an act of financial self-sabotage. Their origins were supposed to be stability, their role to act as the lender of last resort. Yet, they became the hoarders of last resort, as credit markets seized and banks began to fail across Europe and America. The problem was compounded by dogma. In a deflationary spiral where prices and demand are collapsing, the prevailing wisdom dictated that central banks must remain passive, some even arguing for higher interest rates to protect the currency peg and purge the excesses from the system. Imagine an emergency room where the patient is bleeding out, and the doctor insists on draining more blood for the patient's moral improvement. This was the economic policy of the era. The Fed, paralyzed by political infighting and ideological conservatism, allowed a devastating contraction in the money supply. They stood idly by as over 1/3 of American banks vanished. The mistake was not the stock market crash. The mistake was a subsequent monetary tightening, the refusal to provide the necessary oxygen of money into a suffocating system. And here's the twist, the hidden truth that no one on the financial news networks will discuss. Central banks today are repeating the tightening mistake of 1931, but they are doing it with unprecedented speed and scale, knowing the consequences. The part no one talks about is the implicit bargain. In the modern era, the perceived mistake is inflation. To crush this inflation, central banks have hiked interest rates faster than at any time in the last 4 decades. This is the modern-day equivalent of protecting the gold standard. They are prioritizing a statistical target, the 2% inflation rate, over the stability of the financial system itself. They are deliberately collapsing demand, creating asset devaluation, and freezing credit. The real reason is a matter of credibility. They spent a decade printing money. Now, to regain institutional trust, they must show they are willing to inflict pain. And the price for that regained credibility is a looming systemic fracture. The fallout is already here. Who benefits? The creditors, the banks, and the largest corporations who can weather a credit drought. Who loses? The small businesses, the highly indebted sovereign nations, and the millions of ordinary people whose jobs and mortgages are tied to cheap, flowing capital. The analytical expert view is chillingly clear. When you raise the cost of debt so rapidly into a world saturated with record-high debt, government debt, consumer debt, you don't just slow the economy, you force a deleveraging cascade. The weakest links, regional banks, leveraged hedge funds, or highly indebted European states will snap first. This is the calculated risk. Central banks are sacrificing the periphery to save the core, just as they did in 1931. The shocking similarities are unavoidable. The Fed's refusal to inject liquidity in 1931 led to a collapse in bank lending and the money supply. Today, their high interest rate policy is causing a collapse in asset values, the other side of the same coin. The recent crisis in regional banking was not an isolated incident. It was the direct, predictable result of the central bank's tightening schedule. They are forcing economic contraction to solve an inflation problem caused by supply and fiscal issues. In 1931, the central bankers held onto their gold. Today, they are holding on to their dogmatic high-rate policy. And in both cases, the consequence is the same. They are actively pushing the economy from a slowdown into a crisis of solvency. Based on the current trajectory, the next 6 to 12 months paint a perilous scenario. The tightening cycle will either have to halt, triggering an immediate rebound of inflation and confirming their failure, or, far more likely, it will continue until a major financial institution fails. This will be the moment of capitulation. Expect to see a sharp spike in corporate defaults, followed by an emergency pivot of frantic, panic-driven reversal back to quantitative easing and zero interest rates. But by then, the damage will be done. The credit market will be broken, and the public trust in central bank competence will be permanently shattered. We are on a high-speed track toward a crisis that will not be defined by prices, but by defaults and unemployment. They say those who do not learn history are doomed to repeat it. But the real horror is when those in power know history, acknowledge the lesson, and yet still choose to repeat the failure, believing this time they will be smart enough to control the inevitable spiral. In 1931, the mistake was inaction. Today, the mistake is aggressive, dogmatic overreaction. The world's central banks have confused a powerful medicine for a destructive poison, and as the global economy trembles on the brink, remember this truth. The deepest financial wounds are never inflicted by the markets. They are inflicted by the hands that claim to heal them. The financial storm is coming, and 'tis time the architects are inside the very buildings meant to protect us. The question is no longer if the dam will break, but who will drown in the deluge.